Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing, and I'll share my opinions as we go through it together. If you want to follow me, it's at Financial Finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these sectors and topics, looking for investment opportunities. May Day is the coupon code if you'd like to join. So HFI Research, natural gas storage report today, plus 13 billion cubic feet, was 33 BCF tighter than the implied balance. I think most of the underestimation of tightness comes from understated power burn demand. Production, in the meantime, continues to remain low thanks to low prices. So here is the production. You can see it is coming back down. It's pulling on back from low prices in natural gas. Here is power burn demand, and that has been relatively high in terms of power burn. So that's natural gas that is burned for electricity is what they call power burn. Coming down to big orange. OPEC delaying the trimming of their cuts by 2 months tells me three things. Supply demand, there was never the deficit being forecast. Price pushes it back up, and geopolitics helping Trump. I did not come to those conclusions. So whenever you look and you see price data, this is price data in terms of oil. People start to they see evidence or data, and then they come and draw to conclusions. To be a good investor, you want to draw the right conclusions, or the conclusions that have the highest probability of success. Supply demand, there was never the deficit being forecast, but there is the deficit because we're still running deficits in inventory. So if inventory is continuing to decline, which we have, that does have the deficits. The reason they're trimming that back is because they don't like to see the price action break below these support levels. So the deficits exist. And what they're looking at is I think they're trying to hold the price up to some degree. And they're saying, why is the market selling off? If it's going to sell off, we'll just continue to draw down their inventories. And that's the response that they have. There could be some portion of war going on between multiple countries here. There could be. They want to hold the price of oil down because Russia and other countries, they finance a lot of their governments. They could finance war with high oil prices. So some of this could be strategic by the United States to try to bring the price of oil down, whether it's through futures pricing or through release of strategic petroleum reserves or all these different things, because we are at war with people who have commodities as their revenue. Prices pushes it back up, geopolitics. I don't care about the 2 and 3, but I think the supply demand, I think we're tight. And I think the price going down there could be political things tied to this. I'm not saying that it's 100% political. I'm just saying it could be. And that's where I think they draw these conclusions like, oh, the deficits were never that bad. It's like, dude, time out. Like, it's way deeper than that. That's just a surface level thing there. Brandon Balo says the floor incentive price for silver keeps rising. The total weighted average cost of production among the leading silver miners rose to at least $26 an ounce. There are a lot of small producers that make gobs of cash at $26 an ounce silver. This is bullish silver. So this is what it says here. Rising silver prices will, in theory, incentivize more production, but the costs of extraction are rising sharply. Metals market analyst Steve St. Angelo estimates that in the first half of 2024, the total weighted average cost of production among the leading silver miners rose to at least $26 per ounce. And that could continue, and that's what makes the physical investments in gold and silver so enticing is because if we do get into a highly inflationary environment, the cost to extract these minerals continues to rise. The margins of the companies may not be as big as some may wish they were, given the inflation costs. But your physical commodities don't care about inflation. It loves inflation because if the cost curve continues to go up, that is your minimum price that the commodity has to be for the producers to produce. And if you continue to push the cost curve higher, then you're just pushing the lows of that commodity up and up and up and up and up. Here's Analytics AI. It says this was scheduled return of oil production. A 2-month delay doesn't move the needle much, but it's a market sign that OPEC Plus is willing to make changes to hold the floor price. So this was the OPEC's planned production increases coming up starting in October, but that might be delayed by 2 months, pulling it back. So this is greater output would soon overwhelm some members' compensation cuts, is what they'd say, and this is compensation cuts there. And that's planned increases in the black, and then the net increase from September baseline. So about 2 million barrels as we go out about a year from now. Calvin says close to 7 million barrel liquids draw, which was the draw this week in the U.S. Drain it to zero. Make the 1970s great again. I just started laughing. Let's draw this thing to zero and get the shortages, right? Make the 70s great again. U.S. production already flatlining. At $70, I'd bet money you have outright contraction as we enter Q1 2025. So some people are wondering how robust is the production at $70 for the United States? Could we start to decline? We're already flatlining in shale oil. Could we get an outright decline or contraction coming up over the next months or so if oil stays cheap? And what does that do to the price out in the future, too? Russia gold buying, I guess they're buying a whole bunch more gold. It says Russia will increase its gold purchases from 1.12 billion rubles per day to 8.2 billion rubles per day for the next month. This is a big increase. Wow, is what he says. Here's mining catalysts. Major gold discoveries are becoming more and more rare. So this is looking back to 1990, and these are all the major gold discoveries. And you can see on the right-hand side, since 2014, there's been very little gold discoveries in terms of size. Very large-sized gold discoveries in non-existence. And this goes for everything, guys. This also goes for oil. If I were to pull up a chart of oil going all the way back into the 50s, 60s, and 70s, that's when all of the oil was found, was pre-1990, basically. And now, if you want a fun fact, we are consuming 4 barrels of oil for every 1 barrel we are finding. How long can that last? And how quickly do we get into a problem where oil becomes a problem? Because if you're consuming it faster than you're replenishing it, obviously at some point you're going to have a problem. When is that problem and when is the exact timing? And that's what everyone's trying to guess. Is it this year, next year, a few years from now? And when does that come into contact with great fiscal spending and the deficits of the United States? Because deficit spending puts money into the system or credit and debt, which then puts oil into a shortage. And if you have supply constraints, it puts it into a greater shortage, which is then, therefore, your inflation. That is where inflation comes from. It is a disconnect between credit creation and the ability of oil to increase in production. The Young Pretender says the falling price of oil is the prelude to the monetary reset. Saudi and OPEC will no longer have to accept further fiat underpricing of their product once they have effectively priced it in gold. And I don't know if they're ever going to get that in terms of their pricing in gold or when they're going to get it if they do get it. Probably wars will go on around that. OPEC says 8 participating countries have agreed to extend their additional voluntary production cuts of 2.2 million barrels per day for 2 months until the end of November of 2024. And that is also this week, we got an EIA oil and products inventory report of a draw of 7 million oil barrels. 7 million barrels, guys. And we still are struggling to maintain oil price. So this is the sector fundamentals at this time colliding with the big macro fundamental or the big macro picture. The macro picture is recession weakness, uninversion of the yield curve, and all that, uh, versus the fundamentals of us drawing down inventory. That's the two colliding, and that's where oil price is still slightly pulling back because of the macro picture, not because of the fundamentals. And that's where the uranium guys also get a lot wrong. They continue to spout the fundamental of the sector, but it's colliding with the macro big picture view, just like oil is here. A finance guy says, buying my first home is such a stressful decision. I don't want to make the wrong move and buy too early before a market crash or economic crisis. I don't want to make the wrong decision by waiting for something that might never happen. I'm getting input from my parents, my friends, and complete strangers on what I should do, but I don't know who is right. Messing up the biggest purchase of my life is my biggest fear at the moment. Well, I don't think you can really mess this up too bad. I wouldn't look at a home as an investment, and you're kind of looking at it as an investment the way that you're describing this. Here's some things, some things that I think of. I own a home. I bought it in 2017 or 18 or something like that. That's when I purchased this house, at least. Um, you got to get your foot in the door somehow. You got to get inside the game. Once you get in the game, you kind of don't really care after that, in my opinion. So getting in the game is the toughest part, and that's what you're struggling with is getting in the game. So I got in the game, and I'm never going to go back to renting ever. So that's one thing. Once you're a homeowner, more than likely you're never going to go back to renting. And a lot of people who rent, they're like, oh, why would you ever want to buy a house? Because I don't want to deal with an owner. I want to be the owner. I don't want to deal with that crap. And I know a lot of people say, well, I don't want to deal with the maintenance or I don't want to deal with whatever else. It's like, well, you're paying for it. Um, as time goes on from your purchase price, and the further you get into the future, away from where you originally purchased the house, it's going to become easier and easier to afford. And as you go on, you can also, if this were to occur, if we do get a slowdown in the market, you can refinance the house, which will then lower your payments, your mortgage payments. Yes, it's not going to lower your insurance and it's not going to lower um, your property taxes, but it will lower your mortgage payment if you get lower interest rates. And we could see drastically lower mortgage rates, maybe. Maybe it could be the case, maybe not. Uh, but all I'll say is I wouldn't look at it as an investment. I would look at it as a lifestyle change. And depending on where you're living today, if you're living with your parents or if you're living in a uh, small one-bedroom apartment or something, it's going to be a big difference because you don't have people living with you and you don't have people living right next to your walls. You're kind of just breaking away. And here's another thing. As you become wealthier and wealthier, when you see very rich people, do they rent? Very rich people, a lot of them. I would say the overwhelming majority own their house. So you're fitting in more so with people who are wealthier, and they don't want to deal with. My guess is they don't want to deal with renting and the owners. That's my personal experience. So um, I think buying is a good decision, but that's me. Today is the 11th test of the 2550 resistance zone. The more times resistance gets tested, the more likely it is that it will break. I'm guessing next week gold will surge through the level, crushing the shorts. That's his opinion there on the short term from Gary. I don't really play the short term all that much. I know a lot of people get very persuaded or emotional based off of short term price movements. I just focus on the long term and accumulate when things are cheap. And I just feel like the rest is going to take care of itself with time. If you continually buy when things are cheap and the background market conditions are favorable for those investments, at least historically, then it's just a matter of time, and you just have to be patient for it to play out. A lot of people are worrying about the little zigs and the little zags in the short term of all these different commodities. They get so stressed out if we get a pullback of 30, 40, 50%. And all I'm going to say is that is absolutely normal in commodity bull markets to get these 30, 40, 50% pullbacks. There's nothing you can do about it. And trying to time it will probably make everything worse. So the key thing here is buy when no one else is buying. Just buy it when it's down. Do not chase price. Chase patterns. Chase when the ratio is cheap. Buy when it's undervalued, and buy it when it's down. Don't buy it when it's falling off a waterfall. Buy it when it's consolidating and it's down and it looks like it's basing out. That's what I would do, and that's how I have approached most things. Eric Nettle says the lower 48 production has been flat for the past 8 months, and Rystad forecasts lower 48 production to be flat for the next 9 months, which equals zero year-over-year growth by November of 24. The narratives of surging U.S. production, efficiency gains, and OPEC losing market share to shale, we believe, are false. So that's his opinion there, and the research that they probably get from somewhere else. So this is, again, lower 48 oil production is flat for the next 9 months is their guess. I'm not so quick to jump on this and say that this is 100% will be flat. I'm going to wait and make that decision to see what shale can do if the price goes up, because that will be the test. If price goes up and there's an incentive to increase production in shale, I want to see if they can increase it. If they can't increase it, then I would say, yep, we're flat. We can't produce it anymore. But I'm going to hold off until oil prices go back up again, and that might be a little bit. It might not be, next month. It might take 6 months or a year of going sideways for a little bit before we get another big surge in oil. It very well could be that length. Here's gold silver. It says global gold ETF monthly flows have been increasingly positive since May 2024 after 11 months of outflows. Look at the buying here for ETF monthly flows here. That's a lot these past few months. Here's BTC crypto latest has fallen below most key moving averages, including the weekly 30 MA. So this is the Weinstein's benchmark. So now I'm watching the biweekly 30 moving average, whereas you can see the results of which after slipping this moving average here with the large red arrows. This is the Weinstein stage 3. So you get a stage 1, a stage 2, a stage 3 distribution phase, and then a stage 4 decline. Is this the case? I don't know. I'll watch it. I'm very interested in seeing how Bitcoin and Ethereum perform during a pullback in the overall markets. This is the first big pullback, I think, that this could experience, where we'll see how resilient it is. I'm curious to see how these mining costs continue to go way up. If the price goes way lower, what does that do to the fees, the transaction fees? That's really what I'm watching and seeing how sustainable Bitcoin really is over the longer time. Investment wisdom, the investor wanting maximum results should favor companies with a truly long-range profit outlook, says Phil Fisher. So a truly long-range profit outlook is where you want to be. But you're going to have to buy this and hold it for a long time. And a lot of people are going to try to trade their way to success. Traders are not very successful. The really rich people in the market, the Buffett types, the Lynch types, all these guys that are multi-billionaires, Manish, and all these other guys, they are a buy and hold. And what they will tell you is two things. Asymmetry is incredibly important. And what that means is that you need to have a boatload of upside with limited downside risk. So that means that you're buying when there's fear in the market. Be fearful when others are greedy and greedy when others are fearful. And then you want to hold on for a really long time, like a really long time, if it's a company that controls the selling price. So that's what they do, and that's how they make all their money. It's not trading in and out. It's not short-term profits. None of that. It has nothing to do with that. None of those people are rich, as rich as these guys. None of them. I don't see a bunch of billionaires telling you that they made all their money off of short-term trading. I just don't. I don't hear it. Martin Pelletier says, as a Canadian, not sure what scares me more, the existing federal government or the fact that 40% of Canadians support extreme left-wing policies. That's exactly what I think in America. I don't know what scares me more, the actual government or the people that are supporting this extreme left-wing policies that we have here. It's crazy. Peter Schiff says, gold is just 0.5% off its all-time high. Yet nervous gold stock investors sold their shares so aggressively based on this week's slight dip below 2,500 that the GDX and GDXJ must rally 6.5% and 11.7% to match their respective highs from last week. Buying miners today is a gift, in his opinion, and I think they're cheap. I think it is a good idea to be looking at that sector right now. All of the tailwinds are behind gold and silver. They are not behind oil at this moment. Or energy. And that has shifted given the yield curve. And if you're part of the website, I've talked about this for months, and it's probably been for 6 months to a year. And you know my favorite sector at the moment. Everyone's able to name it, and they know probably my top 4, 5, 6, 7 companies for playing the gold, silver area. It deals with the yield curve. Seriously, people, quit worrying about the cartel. The cartel is dead. In that terms of the cartel trying to hold gold and silver down. I don't know if they ever were holding it down to the long term, but that's all broken out for sure. JC Parrott says bonds hitting the highest levels all year, and that's the yield curve uninverting. When that uninverts, bonds go up and money goes into that market. Freight futures, AM update. So Capesize and Panamax are both up, and dry bulk and tankers are flat. We've got investment wisdom. All intelligent investing is value investing, acquiring more than you are paying for. So you're identifying the difference between the value of the company and the price, and then there's a gap between the price and the value. And all intelligent investing is where you basically buy to realize that gap in price and value. Everyone else who overpays for the business is not intelligent. It's not a smart thing to do. John Templeton says, if you want to become really wealthy, you must have your money work for you, not you work for your money. Another one from Eric. He says, preemptive, proactive, and precautionary, OPEC Plus and 8 members of the voluntary cut, showing that they will not push barrels onto the market. Good for quarter 4 and 2025 balances with improved compliance from Iraq. I think draws in quarter 4 will surprise most, in his opinion. And there's that minus 7 million barrel draw from the EIA, and the estimate was about 6 million for his estimate. The gold monthly candle chart is a thing of the beauty. Just keeps ripping higher. Looks incredibly bullish. Gold's backtest of $2,500 can be a daily cycle low, and gold's next up move could be starting now, according to Grady. I've said that you need to take my charts seriously. I'm just trying to help as many as possible get on the right boat. Gold is gearing up, and so should you. Get ready. Here's another one from Eric Nuttall. Widening deficits to normal levels for both oil and Big Three are not bearish. In stark contrast to now, overwhelmingly horrible sentiment. So U.S. commercial crude oil inventory is still on a very low level versus the 4-year average. And this is the Big Three. We can see where we're at versus the 4-year average, which is below the average. So the fundamentals of the sector continue to run in deficits, continue to draw down inventories. It is not from the fundamentals of the sector. It's, in my opinion, from the big macro picture that we're seeing weakness. It says, how will GDXJ perform after the Fed cuts? So gold stocks, actually, I read this one last time. So we're going to end it there, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And that's all I've got for today, guys. So we'll catch you next time. This is Finding Value.